This is how it exactly looks like. Uh, as we go ahead, I'll be taking you some of the live screens, and then also I'll be showing you. First, what I would like to share is actually in the academic interest, I'll share with you the concepts. Once I share with you the concepts, most of the concepts, and then I'll be actually taking you on a live screen, and then I'll be showing it to you how exactly it looks in a real time. Yeah. So now various emotions. Now here I would like to touch upon some of the most popular. There are so many indications. There are so many what should I say patterns. But I would like to indicate you a few. The first is actually a bullish engulfing. The first one in the last, the corner which you see is actually bullish engulf. There is a small bearish candle, and which is actually the bullish candle completely engulfs it, which again denotes a trend reversal. This is called an engulfing. Basically, with this follow-up candle is much larger in body, which covers the open, which covers the low. It covers both the points completely. Then only it is called engulfing. Now, based on the color, you denote whether there is a bullish engulf or a bearish engulf. Obviously, you know the situation. If the red candle or the bearish candle is larger than the bullish candle, it is bearish engulfing. If the green candle or the bullish candle is larger than the red candle or the bearish candle, it is bullish engulf. We already know about harami. Basically, it's like a pregnant. It's like a swollen middle part. It's like a harami is nothing but a pregnant. Then there is something called a dark cloud cover. As you can see here, the most important part is, it closed, the first previous candle actually managed to close very high. But the follow-up candle, the closing is lower than the half of the large candle. Now, there is some dark cloud. Dark cloud cover actually denotes some kind of uncertainty. Market is not sure. Market is not sure which direction it actually wants to go. Yeah, the follow up here, the follow up candle is most important. What happens next is most important. Is it a confirmation of the bearish trend, or is there a reversal or continuation of the current trend, which is most important? Then I'd like to, everyone would like to have, see this rising sun. What do you mean by rising sun? The market is a drastically, it's coming down, it's falling. And then suddenly in the bottom, you find, it need not be as big candle as what you are seeing example here. It can even be a small candle at the bottom, and the follow-up candle are above. The follow-up movements are above the particular level. It is called a rising sun, which denotes, which definitely denotes, a positive movement or a trend reversal. Now, these are the various emotions I'm trying to capture with you. Now, these are some of the patterns. Now, apart from that, I would also like to highlight about these two. These are either hammers or it's called a pin. Yeah. Now, if this hammer, inverse hammer, I would call, happens at the top, definitely, now the swing is trying, definitely what is trying to say, there is a huge selling pressure, and then the closing is below the opening. This definitely denotes weaker strength in the market. Similarly, look at this. There was a fall, but the stock managed to pull back and close even above the opening, which is actually, if you find this in the bottom, that denotes strength in the market. Yeah, here, the whatever is the wick, based on the wick strength, whatever is the wick strength, uh, if the wick is on top, the body is in the bottom, definitely, there is weakness. Most of the times it's weakness. It doesn't matter whatever is the color, it usually doesn't matter, it denotes weakness. If the wick is in the bottom and the head or the body is in the top, definitely it denotes strength. Now, here, the most important we often find is a doji. Doji is a neutral pattern. It can happen at the bottom, it can happen at the top. Actually, when you have no clarity, who is the driving force of the market, whether the bull is the driving force of the market or the bear is driving force of the market. You all should know by now that market is actually a tug of war, a fight between a bull and a bear. It's actually bull trying to pull market upwards and a bear trying to downwards. These are the set of traders, or for simple terms, we call them operators. Yeah, we call them operators. Now, who are these operators? Beyond you and me, like retail traders, there are large institutions, there are mutual funds, there are institutions, financial institutions, foreign institutions. There's so many people with huge money power, buying capacity, and people who can actually take care of the direction of the market. So collectively going ahead, we use one word for them, operators. Yeah, we will use that word as operator. When we say operators, it's a collective word. या तो हिंदी में it's like पूरा गांव आ गया. या गांव का मतलब in typical in the stock market is when the retail participation comes. Retail participation is a minuscule when the major part is actually by the institutions. They actually set the trend, and if you follow the trend in the right direction, you're going to make money. If you go against the operator, the chances of you making money comes down drastically. Now coming back to doji, you might find the direction is not decided yet. Yeah, that is where there is it looks like a cross, which means undecided, uncertain. Only the follow-up candle, if it manages to be above the doji, it confirms bullishness. If it is below doji, then it confirms bearishness. Yeah, there are still several others like a spinning top. Even this is like a spinning top, as you can see. Yeah, the same hammer, if you inverse it, actually it becomes a spinning top. This is some of the some of the formations. We'll be talking more now. Before we even understand what's a candlestick, now I come back. Now these are some of the formations which I explained, which I will be going through much deeper as we go ahead, and even practically. Before that, I would like to talk to you about what is a candlestick. Now, candlestick is actually a collective imagination of the crowd. Now, what do I mean by collective imagination? Now, this is the part. Now, this is about the collective imagination of all the traders, all the stakeholders in the stock market. As I already mentioned, it could be individuals, retailers like you and me. It could be institutions, like it could be mutual funds. It could be insurance companies. Yeah, insurance companies put a lot of money in the stock market. Yeah, and then it could be banks, treasury operations. Yeah, it could be treasury, it could be foreign institutional investments, yeah, foreign individual investment. A lot of things can actually come collectively. Now, what is this collective? We do have I have an idea. Now, this is what is called as a collective imagination of the crowd. Now, actually, when you put the word collective unconscious, which means this is not happening consciously, because I'm not in touch with you, you're not in touch with anyone. We all are working independently in our own world, but we have a path, we have a specific way we behave in the market. Now that is unconsciously happening. So when you look at a word called collective unconscious, which refers to structures of unconscious mind which are shared among beings of the same species, it is termed by Carl Jung. Yeah, according to the Jung, the human collective unconscious is populated by instincts. Now, my instinct is telling that market will go up. My instinct says market is weak. Yeah, or we also call it as a gut feeling, right? Yeah, these basically archetypes. These are basically archetypes. So trust me, market only moves by these kind of archetypes. There are set pattern. Yeah, because this has happened in the history. We have noted down the history. We are trying to track it, and then we are going to see what it might look like in the future. So that's exactly is technical analysis. Now, history repeats itself. Just because we have seen that over a period of time that history repeats itself, that is the whole reason why we are tracking historically. Now, I may track. How does it matter? How many period should I track? Traditionally, about at least whatever period I'm looking at, whether 1 minute or 1 hour or 1 week. Typically, I should be looking at about what happened in the last 200 sessions is important. 300 at the most. You anyway, you try to measure between 200 to 300 period, and then you can actually collectively see where this is actually going, in what direction the market is heading, whether you should be buying or whether you should be selling. This is a very interesting picture. This is a very interesting picture. I want you to Google it and find out, because this is part of the nature. A lot of things we do in the stock market, we are going to explain, we are going to learn. We are also part of the nature. We'll be talking about Fibonacci, which is a natural phenomenon. Yeah, which is very much a natural phenomenon. We're going to talk about Fibonacci. Similarly, even the candlesticks, the collective consciousness is also part of the nature. So as long as I am part of the nature, as long as the market is part of the nature, this is where we need to work and to follow the nature. Okay, that we will be doing it. So as we go ahead. Now, The next most important thing which we're going to talk about is, is there a direction in the market? How are we going to benefit from the market? We are going to benefit only when we are able to ascertain the direction. Here, I'm not even trying to give you a word called bull, bear, or nothing. Basically, market moves in channels. As you can see here, as you can see these lines, market moves in channels, right? Yeah, as you're seeing, market moves in channels usually, whether it is an upward movement, whether it is a downward movement, or whether it is a sideways movement. As you can see here also, it's a clear demonstration. Even the sideways movement, the downward movement, it's all moves in channel. Now, what is guided in this channel? There are supports, price at which it comes, halts, and then turns back. These are called support levels. Then there are some price points at which it hits, it comes back, retraces. This is called resistance. Then obviously the stock has to break both the levels, both at the top as well at the bottom, not at the same time, at different points, at the different points when the emotions are different. Then that is called as a breakout. When it breaks out of the channel, then it is called a breakout. If you are a stock trader, if you are interested in making money, you should be keenly watching when it actually breaks the channel. Being in channel is common. Yeah, you can actually trade. That's called a swing. You know the swing, basically you know the swing and you want to trade in the swing. But when it breaks, you have a bigger opportunity to make money. So here the most important concept you need to understand is we need to know the direction in which it is trading. Is it trading upward? Is it trading downward, or is it trading sideways? And what is the channel? First you need to understand the channel and then understand what can be the breakout point. Now, before we even understand this support and resistance, before we actually understand, there has to be a midpoint to it, which is nothing but a pivot point, a fixed point supporting something that turns on balances. Now, this is a simple example which I'm trying to see. This is the midpoint. This is the midpoint. This is the midpoint as we are talking. Yeah? Even in our own human body, it could be the neck, it could be your arm, it could be your midpoint. As you can balance, when you sway, you actually make balance. Those are the pivot points in your body. Similarly, even in the stock market, even in the channels, you have these pivot points. We're going to mathematically also learn. Here, as I promised you, it's not just about learning completely academically. It's about practical, where you can actually apply, implement. So I'm going to give you those points. This course is entirely going to give you so many takeaways which you can go back, implement it, apply it, and use it right from day one. As you finish this chapter, you'll be able to use and implement it straight away. So it's necessary to understand market actually moves from a pivot point, and the upward ranges are known as a resistance. There can be first level of resistance, there can be second level of resistance. Then if it comes down, there are support levels. There is a first level of support, then there can be second level of support. There can be subsequent level of supports also, and breakouts, which we'll be discussing as we move ahead. As I told you, I'm going to give you a lot of concepts first. Then we're going to explain, how exactly it works in the market. Yeah. Now, what happens when above resistance, above resistance, when it is able to manage above resistance, these are called breakouts. Now, these breakout movements are much larger. Yeah, larger than what it is possible with the pivot and resistance. Those breakouts actually give you big money. Now, below support are, the breakouts are called, that is again, below resist support, there can be breakout. When as long as it maintains within the channel, that is where you call it as a sideways movement, which means market has no direction. Possibly it has a small range which it keeps playing, but the big thing is yet to come. So you need to wait for that big thing. So that's a sideways movement. Now here it is to simply, to give you some simple examples. Now, those, once you know how to mark a pivot, and then after you mark pivot, you know what is the resistance level. Anything it crosses substantially, yeah, above, then it is called a breakout on the upside. Similarly, it hits the resistance and retraces. You know that, it is trying to set the top. The stock is trying to set the top. There is a resistance. There is no fresh movement until, there is no fresh opportunity until it crosses that level. So it becomes a resistance. Now, again, market tries to say take support at some level. Yeah, tries to take support and makes another attempt. There can be multiple attempts, at the resistance level before stock actually breaks out. This you will see as you go ahead. You will see that many times, the call comes, you have the call, you have the information with you, and then it doesn't, it fizzles out. Basically somewhere it hits the resistance, and then there is a retracement of that stock. Now that's what we are going to see. This is about pivot, support, and resistance. Now here, basically when you see this, in a chart, when you are seeing in this chart, even in this moment, it starts making its own resistance and supports. Now what are these support levels? Basically these support levels are nothing but where actually people are coming forward to buy the stock. The resistance levels is nothing but where people are actually initially they're dumping the stocks, they're trying to sell the stocks which they have picked up. Now when there is a breakout, there will be fresh buying, there will be re-entry, there will be a lot of buying which happens. But this is every time when there is a resistance, and if the stock manages to cross that level, that resistance becomes the support, as it is explained clearly here. When you draw, when you point, when you draw these points, actually when you have drawn these points, and then anything more than 2 points, if you can connect and draw this support line, now this becomes the resistance. As you can see in the falling market, this becomes resistance. What was support in a previous rally becomes resistance in the current market. Yeah, this also we are going to practically see. We are going to draw some lines in the real market scenario, and we are going to see. Here I'm only introducing you to the concepts. Now, how do you calculate? Basically, once you know the open, high, low, close, we take these 3 points, high, low, close. We take these 3 points, and then yeah, the pivot point is calculated. So let me give it to you how actually we can actually calculate these pivot points. The standard pivot point is also called as a 5-point system, as it involves 5 different points: support 1, support 2, resistance 1, resistance 2, and the pivot points. Calculation is based on a simple average of previous day's high, low, and close price combined with 2 support levels, S1 and S2. Yeah, and then the R1 and R2. That is where you derive at the new pivot point. The equations are as follows. I'm not going to talk to you about the formula. It is in front of you. It is actually S represents support, and R of course represents resistance. Yeah, this is how it basically, if I'm looking at, as I told you, coming back to that example of 100 rupee stock which I told you earlier, the high is 105, the low is 95, the close is 100, divided by 3, 100 becomes the pivot. Now when I add, how do I make R1? Yeah, when I add that, multiplied the high, again the pivot multiplied by 2 minus the low becomes resistance 1. Similarly, when I actually multiply by 2 the pivot, and then minus the high becomes support. Now this is how you actually, and then this is how you need to continue doing this. That is where you actually get the resistance and support level for the stocks. These are the psychological stops which a stock, you will see these are psychological stops. You'll see the stock actually stopping at that point. If it crosses, means what? There is strength, there is power in the market to either move up or move down. Yeah, normally these are the stops, these are the points at which stocks keeps trading throughout its journey, throughout its lifetime. Yeah, the points do move, it's dynamic in nature, it does move. We will see that how it becomes dynamic.